smile through. Good morning to you.
Okay. So happy Friday, everyone. Thanks for joining. Hopefully the agenda is showing on the screen. If not, please just message me, let me know, and I will get things moving. Let me just close a few screens here. So agenda for today is we'll start with a quick review of investment markets, the main asset classes, returns from typical diversified portfolios. As I'm sure you're all aware from looking at your balances and seeing recent headlines, it's been another good year, which is great. Returns have been pretty healthy, notwithstanding some volatility earlier in the calendar year, in shares, which is not unexpected, of course. That's the whole point with shares. It does happen. So that'll be part one. Part two, we're going to review an amazing book. I'm a big fan of Tony Robbins, have been for a while. So I just thought a good chance to share some of his key principles, and whether, those of our clients that are watching, whether I explicitly sort of articulate it or not in our process, we actually do apply a lot of Tony's principles in how we work with you. So I think these things are timeless messages and a great opportunity to have a look at some of the key principles. That's the plan today. There's also a link here to his blog, his website as well. Just a heads up if I forget to mention that later, which is really good. We've got some book giveaways to go through as well, to give away. So let's get started. This is the MFG Quarterly review, published by our research team in head office down in Tassie. Again, this would have gone to you on email, or actually only just came out 2 days ago. So we'll probably send it out today or next week, but you can either go to the website if you want to have a look in the meantime. I'm not going to go through it line by line. There's plenty of info in here. What I thought would be most relevant is just a very quick excerpt from the review of the main key points for the economic outlook and the economic results in Australia. And really, things are chugging along fine in Oz. Not the sort of strongest, growth. You can see here about 1.5% GDP. So well below long-term trends or forecasts, but that's not a standalone factor, or not only in Australia is that the case. Globally, growth is coming down, but still growing. The upshot to that as well is inflation has come down a lot. You might remember 3-4 years ago it was sort of 8%. So I think, steady as she goes, which is great. As I always say, the economic and the financial market link, portfolio returns, etc., is a very loose connection, certainly in the short term. So it's really just something to keep at the back of your mind when you're looking at portfolios and doing any kind of planning. Since the RBA rate cut in April, they surprised the market last week by not cutting in July, but it's pretty much assured it's going to happen, in the next few months. And the biggest impact or correlation with interest rates is the property market. I usually talk about these numbers because it's such a big part of most people, their wealth pot. Whether or not you can spend your property, obviously, is a different story. But in terms of the value that property represents in people's portfolios overall or in their estates is very significant. So once again, as you can see here, price growth continues, with the exception of Melbourne, which we've talked about in the past. And they've been slugging investors, in particular property investors, with very heavy taxes to try to repair some significant budget damage from all the COVID stimulus that they handed out. Rents are growing as well. So for those clients that are, own investment properties, hopefully that's feeding through to higher income for you. And the key takeaway here, I think, structurally for prices and the outlook, and I know we hear it every day on the news, but it is obviously a really big social and economic issue in this country. The governments at all levels want, or certainly state and federal, want more housing and soon. But so far the numbers are really, really not delivering. So dwelling approvals below target. And the other big item, again, that sounds easy but isn't, in terms of reducing migration, whatever your political, moral, ethical view on that is, already still so far, talking about 400,000 net arrivals in the last 12 months, well above the budget forecast. So the key point there is that regardless of what we're hearing from policymakers, that the supply demand mismatch is still pretty wide, right? So probably still pretty bullish, optimistic for those who already have property or rental properties, etc. The flip side of that, with clients of ours that have kids that are trying to get into the market, obviously very frustrating, but happy to take those calls one-on-one if people are looking at smart ideas about how to help their kids with some of the growth or wealth they have in their property. So that's a quick economic overview. Let's jump to financial market returns. Hopefully this table looks familiar. As I mentioned, so these are the main building blocks here of almost everybody's portfolio in some form or another, depending on what kind of super you're in and running your own fund, industry fund, public offer. At the end of the day, with the exception of unlisted assets, everybody fishes in this same pond, so to speak. So I think it's always really relevant at a high level to look at the different building blocks and the returns on those particular investment classes or asset class, as it says here. And again, left-hand side of the table, cash bonds, global bonds. The first three areas here that I'm highlighting are what we call the defensive or the conservative part of the portfolio. As to how much you have in yours, everybody's different. And we'll talk a bit more about that with the Tony Robbins stuff as well. This side here is your growth engine. And again, the mix and the exposure and the relative levels is different for everybody. But this is where you get the wealth creation over time. Stressing that point over time, as always. We've been fortunate that 1 year returns from Aussie shares, this is including dividends, as a guide, around 13%, right? So roughly 4% dividends, 4-5%, depending on portfolio. The balance of 8-9% in growth. In other words, what share prices were a year or the benchmark versus what it was now. Likewise, you can see global shares have done even better. That's been a trend that has been going on for quite a long time, pretty much at least 20 years, as you can see here, but particularly more pronounced in the last 10 years. Roughly, global shares are doing about a third better than Aussie shares. I'm not going to go into the reasons why. I've talked about many times before. Again, if you'd like a deep dive, don't hesitate to book a call. Having said that, this gap's closing a little bit as well. Those numbers on a 10-year basis, if I was doing this presentation maybe 6 months last year, for example, the gap was bigger. So you could argue, Aussie shares are catching up a little bit with their growth, and maybe US share or global shares, of which US is the main component. The growth rate is slowing a little bit, but yeah, still amazing numbers. You pretty much will look at the diversified, the Vanguard reports in a minute, and that'll illustrate some more happy news, I would say. And then May 25, haven't got the June numbers yet, but again, it illustrates the same principle. And this is my favorite risk management tool, to use a sort of geeky, financial planner term. But that's what I'm here for, is to look after my clients, make sure we focus on what we have control over, understand the dynamics of these different asset classes, how they work together and not work together. In the case of diversification, that's the whole point. In other words, not all move the same way. But this is a great primer for, if you're new to investing, or you haven't reviewed your portfolio for a while, or maybe you've had a change in circumstances that has maybe put you in a position where you want to take more risk, or the opposite, you might want to reduce risk, etc. And so it's a great talking point for those kind of discussions and building something that might be customized to what you're trying to do. And again, that's a lot of the Tony Robbins stuff I'll get to. But let's just pick the top table is the historic returns from benchmarks. So again, not necessarily portfolios we're managing for you. Hopefully we're in this ballpark over time, but just as a guide. So stressing as a guide, this is these are just raw numbers. So they don't include they don't include management fees or advice costs, whatever, just as a guide. And if we look at the 70-30 where my cursor is, the last 12 months, the typical 730 benchmark is about 11% return. The last 5 years about 9%, the last 10 years about 7%. So roughly you would have doubled your money in 10 years compounded. So that's including reinvesting, of course. If you're putting money into super or a savings plan, investment portfolio, etc., then these numbers are sort of the way the maths would work. If you're in pension phase and drawing down, your account balance might be dropping, but the underlying returns would still be these kind of numbers from your shares and your growth assets, or from everything combined. So that's a 70-30 portfolio. So again, it gives you a bit of a flavor for perhaps how things could look in the future. It's no guarantee, but it's just a good planning tool. And what's even more important, I think, is the bottom part of the table in terms of managing expectations. And when things are good, these are easier theoretical conversations to have because, as I've said many times before, the good news takes care of itself. So what I mean by that is we're not too worried about losing money or downside or our portfolio dropping in value when we're having returns of 10% a year, let's say, for your typical sort of 70-30. But what you need to think about is, in order to earn those returns, there will be periods of at least paper losses, hopefully not crystallized if we've done our work properly and you're sticking to the plan. But this shows you, again, if you look at a 70-30 in the last 30 years, which is what this data pack is. So a very substantial data set that's used to build this, which is why I think it's a great tool for educational and planning. So the past 30 years with a 70-30 portfolio, you have on paper in this example would have, on paper your portfolio could have dropped 23%. And a 10-year return, the worst case, you still made money, but depending on where you were in that cycle over that 30 years, worst case you would have made 4%. Best case on average, a return of 10.5% for that 10-year period. So the point in these numbers is to, of course, always hope and plan for the best, but also prepare for the worst and be understanding that, these numbers here in the red is how things could get. They could get worse, right? This is just history. It's only a guide. But what we always try to do is help our clients with that mental framework to know here's how good things could be, but this is also in the short term how bad things can be. Can I see myself sticking to the plan if I wake up in 12 months and my portfolio is down 23%? Hopefully we've done some work to prepare for what we have control over, cash buffers, taking profits. Again, if I good segue to move to the Vanguard numbers now to explain what that means by building cash buffers and taking profits. And if you're a repeat visitor to my coffee meetings, again, these tables should look very familiar. And so what I use as a guide, a real life guide, if you will, to again, a bit of a just general trend of what's happening is this fund here, the Vanguard Growth Index Fund. And what that is kind of one packaged up fund that does all that diversification for you. So this is great for people who just want to, very simple, low cost, transparent, set and forget kind of thing. You don't have control over what you own and what you sell. It just goes on autopilot. But as a guide to what could be happening in a typical 70-30 portfolio, this is again great illustrator. And so similar to the numbers we saw in the table before, bearing in mind that was a May return in the 70-30 portfolio was a bit lower. The 1-year return for the Vanguard portfolio was after their fees about 12.5%, right? And so that's a bit higher than the returns at the end of May, and that's because it was a good month in June, right? Most 70-30 portfolios would have grown by 1 to 2%. So again, looking at longer term, how is a 70-30 done? 5 years, if you're in the Vanguard or some similar kind of structure, which is what we're trying to replicate for our clients. If it isn't a Vanguard, for example, dimensional fund advisors, this isn't advice, just some sample suggestions of portfolios. 8.7% a year compounded the last 5 years, 7.5 the last 10 years. So those numbers aren't dissimilar to the when we looked here, the 10-year number to the end of May, right? 7.3%. The 70-30 portfolio, it should be earning or should have earned around 7% in the last 10 years, which is roughly doubling your money. And how can we look at that in dollar terms to explain what I mean by that? Where are we here? I'll come back to the here's a chart of again, if you invested $10,000 5 years ago, the path of the value of the fund, right? So again, you think of your 70-30 portfolio. Started with $10,000 way back in June 2020, and as you can see, not all up, right? Not all in a straight line, and that's the point. It doesn't, and that's why having the plan set up the right way in the first place is really important, so you don't abandon it at the wrong time. We'll talk about that in a minute with Tony's stuff as well. But you can see here, sort of, and as I flagged before, previous chats, 2022, 2023 weren't great periods for shares, right? The portfolio sort of went sideways and down. 2024 into the start of 2025 up to about January, February, peak price, right? Peak value of your portfolio in this scenario. Then we had the tariff volatility from Trump, and then he chickened out, and we won't go into all that, whatever. But the good news is the value is now surpassed that previous peak in January or February this year. So things have recovered quite nicely, but again, this is a little hairy for some people. But as you can see, those dips are not unusual, right? You can see them all the way through here. And so the trick, of course, to earn these returns, you can't interrupt that process, because if you do, it's usually the worst time possible. In other words, selling at the bottom or buying more at the top. So that's the Vanguard tracker. That's sort of a guide to what has been happening in a typical portfolio. Most of our clients sit 10-15% either side of these allocations. So that's why I think this is a good illustrator. Here's the global share fund. So I don't know anyone that has 100% of all their money tied up in one fund, because it would just be too risky. But this shows you again some of the numbers here. But in most cases for our clients, this is a significant portion of their investment strategy. And that's worked really well, as you can see, right? 10 years, it's made, for most clients, they would have earned 10 to 12% a year, depending on the fund and the timing and everything. So let's move to Tony's book. And so basically, there's 5 principles that he outlines that we think are fantastic. We do it for our clients. As I said, we may not use this language, but these are a lot of these principles we absolutely adhere to and believe in. And the first one is taking control of your financial decisions. So the trick is to have the discipline, to have a target, to not consume everything, right? To actually be putting some money aside. Certainly, if you are pre-retirement or pre-financial independence, it's important to have that discipline and that activity. And so Tony talks about setting some kind of target, right? As any competent, professional advisor would be saying, whether that's 10%, 20%, etc. That's a personal number, but the important thing is to have that number and try to stick to it. And then you're becoming an investor, not just spending everything, right? So that's taking control of your process and your life and your activity. Ideally, paying yourself first. So what that means is when you get your paycheck or your pension payment or whatever, if your goal is to, or you have this goal, again, particularly pre-retirees or people building to that independence phase, financial independence, first thing that should happen is the money comes out of that payment, right? And ideally you automate that, and I'll talk about that shortly. And you want to create a lifetime income plan. So It isn't, again, just about building the largest pot you can for most people and dying the richest guy or girl in the cemetery. It's not, it's for most people, that's not what it's about. And partly the platform to give you what you want to achieve in life, not financially, but the lifestyle, what's important to you and your family as individuals, etc., is creating that financial flexibility and freedom. And so Tony calls it create a lifetime income plan. Um, and so the classic ways to do that are these strategies here. We, as advisors, work in these areas, 1 to 5. But there's also other areas as well. I know some clients who do a little bit of peer-to-peer lending. What that means is you basically go onto a platform and you can lend money through this platform to a borrower. So you sort of remove the bank from the equation, if you will. I'm not necessarily recommending it. Neither here nor there. It's just an area that we have to focus as advisors on the most liquid, transparent, safe, vanilla, reliable areas that have proven time and time again to help people build lifetime income streams. And so that's where we hunt or play or invest for our clients in these areas here. So that's a lifetime income stream, really important. If you've got side gigs or whatever, other forms of income, fantastic, right? It's a good diversifier away from these traditional areas. So that's number one. Number two, know the rules. Know the rules before you get in the game. And so whether you do that yourself, whether you do that working with someone like me, if you're a qualified fiduciary advisor, it doesn't really matter. The important thing is that you try to understand the financial system. It is very complex in Australia, like most countries, certainly countries I've lived and paid tax, such as the UK and Japan and the US, in my investment banking career days. And we use, again, a thing called a tax ladder, where effectively, we all have available sort of 3 or 4 different entities that we could use to optimize our tax, all legitimately, sort of industry standard accepted ways of doing it. So I get rid of that menu. And so that's what understanding the system is. Understand the rules before you get in the game, right? And so with new clients, when they come on, it's always important to try to get that right from the start, the structure, because trying to unwind that or move money from one to another, if you realize you haven't got it right to start with, can be very expensive. Often it's a tax event, it could be transaction costs. If it's property, even more so with things like stamp duty. So the trick is to look at the different, what we call rungs on the tax ladder, and how to maximize that and optimize it, etc. Everybody's different, but we have those things in our toolkit. Understand how fees, commissions, and costs can eat away at returns. At the end of the day, it's what's left over from your investment manager or performance that is going in your pocket. And Tony's very big on again optimizing that, as are we, right? Of course, we charge fees. We believe we charge fairly. The fact that our clients, happily pay us every year means that they feel like they're getting value. We focus on maintaining efficiency with portfolios in terms of costs. But yeah, it's important to know that. And we hear a lot about people's disengagement, usually more on the unadvised side, because if you have an advisor, you're obviously engaged in trying to improve your well-being. With things like super, where people don't know what investment option are in, they don't know what fees they're paying. And so it serves you to know those rules. And that's what Tony's all about. That's what we're about as well. And so part of it, of course, is the behavioral aspect. And so it's less about the rules in that case, more about knowing thyself, or knowing that, as sapiens, as humans, we are prone to biases. And that's, again, in our experience, one of the number one things of blowing up a plan or not performing to what the projection said or what the expectations were. It's really around your own behavior. And the classic one, of course, is getting carried away, buying too high when things are going really well, and there's that exuberance, and doing the opposite, right? When things are dropping and falling, panicking and switching into cash. And that's what's key. That's what Tony says is key, and that's what we say is key, right? Is maintain that discipline. And the way to do that is make sure that your investment approach is founded in science, is founded in fact and evidence. These are the things that's worked in the past. These are the reasons why. I'm going to assume that it's going to continue. And yeah, I might be down in the short term on my portfolio, but it's the best foundation there is because you're using evidence and facts and science to make the decision, not gut feeling and not sort of chasing the latest hot fad. By all means, some of my clients might want to play around in crypto or gold or etc. And there's nothing wrong with that for a bit of, in a way, it's kind of entertainment in my view, or maybe an attempt at diversifying. But the core of what we try to do for our clients is this, as we say, make decisions that are based on evidence. And if you don't understand how it works, don't invest in it. Or come and see us or somebody out there that you trust who is qualified to help you to figure out what it is that you're putting your money into. And so that's about knowing the rules, right? Before you get in the game. Number three, make the game winnable. So these are, again, what I love about Tony's principles is that it's not complicated. Maybe it's complicated to stick to the plan at times because of those biases that we've talked about, but it is a matter of goal setting, is a matter of working as a team, starting with sort of an end game in mind, right? So what's your target that you want to be financially free? Is that X dollars a year in income? Is that X dollars million or hundreds of thousands in the bank? No right or wrong answer. The answer is the one that suits you and what you're trying to do. And then you work backwards from there. You reverse engineer it. Okay, if we want to get there, X time in the future and X dollars, etc., break it down into smaller steps and make it step by step. And then you build a plan around that trades off sacrificing now for the future versus also enjoying time along the way. Tony has a great diagram in his book about it showing a mountain, and you're climbing the mountain to peak wealth, and then you ski down the other side. But it's important when you're climbing that you enjoy the journey along the way. You stop every now and then to, look at the scenery, and so. I think that's, again, with a lot of our clients, we see them doing that, and the pleasure I get from seeing the pleasure they get is fantastic. Steady progress, not perfection. So I say this to my kids sometimes. I say, but at least you're doing something. It may not be perfect. Perfect can be the enemy of good in so many things. And so small actions. Sorry that this menu thing keeps popping up. Small actions compound over time, right? And it's good to stop and celebrate and just go, pat yourself on the back. Great job. I saved X dollars this month, or I managed to renegotiate my electricity contract, and that savings is now going into my super, and I'm getting a tax benefit, or I'm just accelerating my mortgage repayments. So I like to say that momentum builds momentum, right? The more you have those incremental changes, the easier it is or improvements, the easier it is to keep doing it. It's like, not just with financial, but it's everything. If you go to the gym, if you exercise, if you do something, and the more you do it, the better you get, the more you want to do it in most cases. Same with making the game winnable and your financial path and your wealth generation. So a big part of making that as likely to succeed as possible is things like automation, and some of the recent blogs that I've written talk about automating that program, automating it so that it runs in the background. You don't have to make a conscious thought about, let's say you set your savings target, you know what that is in dollars. How are you going to implement that? And so a simple thing might be salary sacrificing additional money into super. To my comment before about paying yourself first, that comes out of your pay. Bang, you don't even have to think about sending it somewhere else. So excuse me, automation is important where you can, because it just, it saves the effort and removes the risk that you don't do it or you second guess yourself. So make the most important decision of your, excuse me, of your life. Make the most important investment decision rather, of your life, which is asset allocation. So in plain English, it's really where do you invest your money? How do you do it? What does it look like? And so the building blocks, as I said before, really, for the vast majority of us, these areas here in some form or another, right? We all, at the end of the day, derive our returns from this set of opportunities to invest. That's it. The exception would be, industry super funds where they can buy a $20 billion airport. So, but for the most part, everything else they invest in is the same as what we get to or have to invest as well. And so the important thing is how you mix that money around, right? And that's what Tony believes as well. It isn't about individuals sort of, again, picking the next winner or the star fund that's done well. And that's where the returns come from, right? It's not picking the next winner. It's actually getting the right balance of those different assets that suits you. And so, of course, we want to make sure that you don't have too many eggs in one basket. And that should be a reflection of, again, as I've said many times, your personal circumstances, what suits you, what you need, what you're trying to achieve. There is no right or wrong answer, but our role is to help customize the plan to what you're trying to do and also make sure that you're prepared for whatever comes so that you don't abandon the plan at the wrong time or the worst time possible. And reviewing and rebalancing is really important as well, particularly if you've had life event changes. So, these things are all frameworks that Tony believes in, that we believe in, and the big part of it is that asset allocation piece, right? Where do you put your money? How is that going to look? And so once you've done all that and it's humming along and we're working with you and, focusing on the results and going through those life planning discussions and hearing about the amazing trip you've done or the gift to your kids or the investment property or the house you bought or the new car or all those wonderful things that the money serves the purpose for, it's important to enjoy it, right? And celebrate it and be in an appropriate way. It's okay to talk about money with family and friends. Again, everyone's different with their dynamic. You might want to in terms of how we work and how we build our business and help other people, it's clients like you that have referred friends and family, and then that's a compounding effect in a way that we can also do good work with them as advisors and fiduciary advisors, etc. And there's again, Tony talks a lot about this in various chapters of his book, that it's he's set up some amazing charities and gives away quite a lot of his wealth. And he came from a very, you would know who've read his books or his courses, very underprivileged, deprived childhood. And there's also a lot of scientific research behind the mental well-being benefits of giving back. Doesn't necessarily mean charity. It could be, financially, it could be time, all those kinds of things. Anecdotally, if anyone's heard of things like the series called Blue Zones, or it's a book, but they now did a Netflix series. And anecdotally, it's this kind of stuff it comes out a lot when they look at in Blue Zones. Areas of the world where there's very long-lived populations. And what is it? What are the repeating factors in that? And in many cases, it's because they're giving back and they're active in their communities and the social outlets, etc. And so Tony believes in that. And we see that with most of our clients, and it's an amazing thing because the money is just a means to an end. It's what you do with that money that is what really, is the driving force behind being human. And those memories. So hopefully that's clear in terms of what we do, what we try to do, and what we hope you're doing if you're DIYing or sort of just starting on the journey, etc. But our goal as your fiduciary advisor is to act in your best interest. Try and remove those emotional influences from the decision and the implementation of the plan. So we're both sort of financial coach, but behavioral coach as well. I said this to many of my clients. My role is to stop you from being your own worst enemy, and I mean that in the nicest possible way. And that's what this stuff is. So often it isn't that it was a bad plan. It was just that someone can't stick to it, or something. The emotions take over and derail things. And so the better way to make sure that that doesn't happen or reduce the risk of the plan not working or people jumping ship from the plan is to make sure you've got a really good understanding of your goals, your values, life circumstances. And that's the foundation, right? Before you build anything financially, because we want to connect those two. And if we do and we get it right, or you do it and you're DIYing, much more likely you're going to get the outcomes you're looking for. So that's sort of the strategic role that we see in our lives. I've talked a lot about sort of the investing piece, and that's what we do, right? We look for the diversified low-cost portfolios, what we call an evidence-based investing process, which many of our clients will have heard me say before. So we're running slightly over, but I think I'm hoping that's been of value. Just to wrap things up again, just a reminder, this is general advice only. Don't hesitate if you're a client to drop me an email or book a call if you have any specific questions. If you're looking at coming on board, you can book a free call on our website, on our homepage, providencegroup.com.au. And we've got a giveaway here for those of you that might like a copy of Tony's book. If you feel like posting a Google review about the work we've done for you, or if you're a new client about today's presentation, just scan this QR code on the screen, and then the first 3 reviews, I'm happy to get the team to send you Tony's book. It's about this thick, so hopefully you've got some time to read it, but it is fantastic. So thanks for watching. Again, just note, we're not affiliated with Tony at all. It's just we believe a lot of what we do is a lot of what Tony believes in, and I think there's some great stuff there for you to think about. So if you already have posted a Google review, then thank you. And if you prefer, just send me an email if you're in that bucket of what you liked about today and what you'd like to see in future. So thank you very much for watching. Have a great weekend. See you in 3 months.
So good morning, sunbeams will soon smile through. Good morning.